Hey everyone, and welcome to This Explainer. Today, we're unpacking the often hidden mechanisms of the mortgage finance industry. This is a sector where deeply internal incentive structures can literally build communities or, on the flip side, trigger absolutely massive legal liabilities.
So let me ask you, what actually drives those incredibly costly mortgage lending mistakes? You know, when we see massive lending failures or huge multi-million-dollar lawsuits in the news, our first instinct is usually to blame broad market forces. But if we really dig into the corporate data, the root causes are almost always found deep within a company's internal communications and their employee incentive programs.
Here's a quick look at our roadmap for today. We'll start with the mortgage finance ecosystem, then move to the cost of miscommunication, followed by dissecting remuneration structures, and wrap up with protecting long-term value.
All right, let's jump right into Section 1, the mortgage finance ecosystem. Our foundational playbook for today's deep dive is the SASB standard for the mortgage finance industry. Think of this as the authoritative industry standard rulebook that details exactly how companies absolutely must report sustainability and financial risks to their investors. Look, mortgage finance provides an essential public good, right? It's what makes home ownership a reality for most people. But, as we all know, there's been a massive regulatory shift since the fallout of 2008. Regulators and investors basically realize that societal interests and long-term investor interests simply have to align. And to make that happen, it demands a much higher, stricter level of transparency regarding actual lending practices on the ground.
Moving right along to Section 2, the cost of miscommunication. Let's look at the highly visible tip of the iceberg here.
Because let's face it, when those internal practices fail, it usually ends up in a courtroom. Standard disclosures require companies to explicitly report their total monetary losses from legal proceedings regarding customer communications or how originators are paid. We are talking about hard liabilities here: fines, restitution, disgorgement, and civil settlements, the real financial hits.
Now, here's a really fascinating contrast. Institutions have to report all those massive payouts we just talked about, but, and this is a big but, they intentionally exclude the institution's own legal defense fees. Why exclude those? Well, because investors want to see the actual financial penalty of the bad behavior itself. They honestly don't care how much money the company burned on high-priced lawyers trying to defend the indefensible. They want to see the pure cost of the mistake. But, just slapping a giant dollar amount on a balance sheet doesn't really tell the whole story. Institutions must also transparently describe the actual nature of the judgment, like, hey, did this involve fraud? What was the context? And crucially, what corrective actions are they actually taking? The numbers alone just aren't enough. Investors need the narrative of what went wrong and how operations are being fixed to prevent it from happening again. Okay, let's dive below the surface. Section 3, dissecting remuneration structures. This is where we find the hidden drivers of those massive lawsuits.
So, how do mortgage loan originators actually get paid? Well, it's a highly complex web of bonuses, commissions, pooled compensation, and profit sharing. Now, obviously, this is all designed to motivate employees, but this sheer complexity introduces a massive hidden risk factor into the equation.
The real danger? That kicks in when a mortgage loan originator's compensation is directly tied to the specific terms of the loan itself. Think about it. If an employee gets a significantly bigger bonus or commission for securing a loan with a larger principal or a higher interest rate or really heavy upfront fees, while suddenly their own personal financial goals are dictating the advice they give to the consumer.
And that sparks a very predictable cause-and-effect chain reaction. You tie compensation to specific loan terms, and boom, you unintentionally incentivize originators to push unsuitable products. This fundamental lack of fair advice harms the customer, which inevitably invites regulatory scrutiny, huge litigation, and deep reputational damage. Those misaligned internal incentives are the direct cause of the massive legal losses we discussed earlier.
Which perfectly brings us to our final part. Section 4, protecting long-term value.
If you look closely at the SASB metrics for lending practices, the metric tracking those monetary losses we talked about sits deliberately right next to the requirement to describe the remuneration structure. By forcing companies to disclose the legal fallout and the compensation models right side by side, investors finally get a complete, transparent picture of true risk.
The standards sum up the ultimate goal perfectly here. Let me just read this to you. Entities that develop transparent information, give fair advice to customers, and clearly disclose their lending practices may assist shareholders in determining which entities better protect shareholder value. It's a great point. Aligning these incentives isn't just about being ethical, it's a practical, proactive way to shield shareholders and the broader market. So I'm going to leave you with this one thought. Whenever you're evaluating the mortgage industry or honestly any financial sector, ask yourself, are an institution's internal employee incentives genuinely building long-term value, or are they silently setting the stage for the next headline-making, extremely costly lawsuit? Thanks so much for joining me for this explainer. I hope it gave you a new perspective on what really drives risk in lending.